I want to take you back some hundreds of years. I think it was 1780 something. And John Wesley, the founder of the Methodist Church, did a sermon one Sunday called The Use of Money. And it's a very good sermon, and I highly recommend that you read it. And this was one of the first documented examples of somebody talking about the importance of using money in a way that is positive for your neighbours, for the world. He talks about using business not to exploit workers. He didn't use the word exploit, but he said you shouldn't make your workers ill from overwork and burdensome sort of chores and so on. He talks about harming your neighbour's land. And really, this is the first time we saw a documentation of an ethical use of money. Now, of course, since civilization existed, there would have been something along these lines. People investing in more values-aligned activities or less values-aligned activities, people whose businesses do more pollution or less pollution, positive externalities, negative externalities. But this is really what we're talking about today. It's about how do we use money in a range of ways from very bad to very good. And fast forward to the 1970s, and we have the apartheid era in South Africa. And this was the first time it became very public and well known around this concept of the use of money. And US pension funds divested from companies operating in South Africa. And this big divestment campaign was all over the media. And this was the first time people started thinking about really divestment on a massive scale. And then we go through to the 90s and the Kyoto Protocol for climate change in 1997. And investors started to think about a lot more about environmental issues. And then we come to the year 2000, which is when I started getting involved. And at the time, I was a long-haired forest activist, and things certainly change. And we were fighting to protect Australia's old-growth forests, 500-year-old trees, incredible biodiversity, particularly in a state called Tasmania. And we were fighting this very large, publicly listed logging company, which was logging, clear-felling forest, and then putting in burning the forest first with napalm from helicopters, because of vast areas of land. They would burn it, and then they would put down single species plantation and put poison carrots to kill all the wallabies and wombats and all of the cute furry animals. So you can imagine what a activist's dream this campaign was, campaigning against this company. And one of the ideas we had is, well, who owns the company? And it was a $1 billion listed company, and we realised that actually a third of the company was owned by Australian pension funds. And Australian pension funds, money comes from ordinary workers. And another third of the company was owned by wealthy Australians, and that was where all of our donor money for our NGO came from. And we knew that wealthy Australians were actually even more, had a greater affinity for the environment than working class Australians, according to the polls. And so we knew for sure that the majority of the shareholding of that company was owned by people who agreed with us. And so we said, well, let's just file a shareholder resolution at the company annual general meeting. And then we can change the company's direction because we know the owners of the company agree with us. So we filed a shareholder resolution, a very sensible resolution asking the company to transition over a period of 5 years into more sustainable strategies. All of these transitions had already happened on mainland Australia and in North America and Europe. Nobody was doing this type of forestry, except maybe in Indonesia. And so we thought, well, this is inevitable. It's a good business case. We made the case that, your customers are going to demand this. Everything's headed towards certification of sustainable forests. This is good business. And they completely rejected our arguments. The company argued to its shareholders, no, we are doing perfectly fine. Ignore these activists. And we got 1% of the vote. 1%. And yet the majority of the actual owners of that company would have voted another way if they knew that there was even a vote happening, which of course they didn't. If they knew they even owned this company, which of course they didn't. So this is what's called a market failure. Asymmetry of information is a classic in the list of classic market failures. And this was a wake-up call for me. And I said, imagine if we could just link up the basic preferences of people with their money and how that money behaves. Money is out there behaving opportunistically, trying to make more money. And I love capitalism. I think that's an incredibly powerful system. But there are externalities, and unless those externalities are somehow priced in by regulators, it is incumbent on people to choose not to externalize. And just like most of you, I hope, would not litter out of your car, why should you be littering, in effect, with your portfolio? So this started a 20-year career in this field. And the first thing I did was do a master's thesis where I compared the two main types of sustainable investing strategy at the time. There was what's called negative screening or exclusions. This is where you just remove the bad guys from your portfolio. This goes back hundreds of years. And then there was shareholder engagement or activism, where the shareholders use their power to actually go and push companies to improve. And I compared these, and I came down very strongly on the side of shareholder engagement and activism. If your goal is to improve the situation, you have to own the company. Whereas most sustainable investors at the time were avoiding the worst companies. And if you don't own them, how can you change them? And so this really put me on a path of saying, okay, we can't rely on excluding bad companies to change the world. We have to rely on owning them and pushing them to improve. So I said, well, who can do that? It has to be the pension funds leading this, because the pension fund members are ordinary people and they have an obligation to use their power to address that information asymmetry and give their members the ability to use that power. So I then I enrolled in a PhD on how to make shareholder activism as effective as possible. So this is sort of halfway through 2003. And it was due to start in 2004. And I had some time over Christmas 2003. And I said, I'll do an internship somewhere. And I found this little unit of the United Nations in Geneva called the United Nations Environment Programme Finance Initiative, UNEP-FI. And it was about 12 people in Geneva working on the intersection of sustainable development and finance. They were amongst the earliest people ever to look at things like green loans, green insurance policies, some of these sustainable investing topics. But they had never thought about the power of pension funds, and they'd never thought about the mechanism of shareholder engagement and activism. So I came along and I said, look, the UN is very well positioned to actually mobilize this huge pot of capital using the UN's brand and convening power And I was hired to take this idea forward. And we then ran a drafting process where we brought the world's biggest pension funds together at UN headquarters on the invitation of the then Secretary General Kofi Annan. And we brought 20 of the biggest pension funds together and said, let's try to commit to a set of principles around sustainability that makes sense and can try to address this gap between the behavior of capital and the goals of your members. And it became very clear that they were not going to be driven by ethical considerations. Because they're like, well, some of our members, you know, smoke tobacco and others, you know, who are we to judge the morality of these questions? And so we coined this term with a consultant called Ivo Knopfel from Zurich, a very well-respected consultant. And we coined this term ESG, and we published the first publication in 2004 called The Materiality of Social, Environmental and Governance Factors to Equity Pricing. And so we used SEG, and then we thought SEG, SEG, doesn't have as good a ring to it, so we swapped the E and the S around and it became ESG. And the reason we did this is because ESG at the time represented a subset of sustainability issues that are potentially financially relevant from a risk and return perspective. Forget ethics and morals. We're talking about sustainability issues that can be material to investment returns. So what might that be? Well, at the time, nobody knew that the Eastern European cement companies' carbon emissions were 30 times more intense per unit of cement than the Western Europeans, than Holcim and Lafarge at the time. Now, the EU was just starting to put a price on carbon. So if the price on carbon goes up a little bit, then Eastern European cement companies are completely uncompetitive with the Western European cement companies. There were no analysts looking at that issue. There was no scenario planning on how a price on carbon might impact the European cement industry. Let's take the forestry company that we were campaigning on back in 2001 and 2002. We argued that unless that company addresses this issue, they will lose customers. They ignored us. They said no. So the activist group I was working for teamed up with WWF and Greenpeace in Japan, where all the big paper mills were buying the wood chips from this company, and convinced the Japanese customers to stop buying from the Australian forestry company. And they lost pretty much all their customers. Then the NGOs campaigned on all the banks in Australia to not finance the company. And all the banks pulled out of financing. And then in 2008, the financial crisis hit. The company had lost its customers, it had lost its financing, and its share price went from $11 to 18 cents. That's financially material. That's exactly what we were talking about on why sustainability issues need to be taken seriously from a business perspective. So the origins of ESG as a term was not about doing good, at least on the surface. It was about making more money. It was a strategy to leverage sustainability, but only the subset that was financially relevant, to then go to big investors and pension funds and say, there's a subset here of these issues that nobody's thinking about that are very relevant to your long-term prospects. A lot of fund managers are trying to outperform in the next 9 months. And the argument we made to the pension funds is, if you look longer term, 5, 7 years, and then you take a broader set of issues, Let's look at how companies treat their workers and develop human capital over the long term. Let's look at their deep community relationships. By the way, African mining, there is a vast difference between community relationships that are successful and empower the mining companies to succeed, and the companies that have terrible relationships with local communities are on the verge of being shut down. So that's another important material issue. So we focused the pension funds on those material issues. Now, this is ironic because now all this controversy you read about ESG in the Wall Street Journal and you think it's all about ethics. Actually, from 2004, ESG was all about making more money, actually, because that was the only thing that the pension funds felt comfortable addressing on these issues, because they have fiduciary duties, which is the duty to deliver investment returns for their beneficiaries. So we flipped the logic. Before 2004, sustainable investing was an ethical movement. It was about getting rid of the bad guys. It had religious origins. But from 2004 onwards, it was about looking at companies through a materiality lens, through a financial relevance lens. And there's always sustainability issues that are financially relevant. Environmental issues, relationship with communities, relationship with workers, building up your workforce, etc. And that is what allowed ESG to grow into what it is today. So then I became the first employee of the UN Principles for Responsible Investment. In 2006, we launched, and I built that organization up over the subsequent 7 years to be the largest initiative in sustainable investing in the world. And it has continued to grow after I left in 2013 tremendously. But something was getting to me towards the end of my 10 years at the UN, and it was that ESG was not going to solve the problems we needed to solve. At its core, ESG was a tool to engage the big guys, big pension funds, to do something, right? It's better than nothing. They're buying research, they're hiring ESG people, it's all good. But it's not really going to solve the world's biggest problems, because the two mechanisms of investment that can really solve problems are early stage venture capital, seed stage, working with entrepreneurs and scientists, bringing them out of the lab and into the marketplace, high risk stuff. But if we're going to solve climate change, we have to get new technologies, we have to get the price of clean, reliable, renewable energies lower than fossil fuels. There's no other way you can convince Indonesia or India to give up cheap coal voluntarily. I mean, they've got a tiny, tiny emissions per capita compared to the West, and they're like, why would we give that up now? So my theory, or my belief, is the only thing that will solve climate change is technologies that are simply cheaper and better. And big institutions like pension funds are not investing in that. Very few pension funds do venture capital. They certainly don't do seed stage venture capital. But it's not only venture capital and technology that we need to solve the world's problems. We still have 1 billion people in poverty, and pension funds don't do frontier markets either. Very few. So who can? Who can? And I looked around and I said, well, governments have a role, but you can't really rely on governments to solve these problems. They don't have the scale. Total foreign aid is in the hundreds of billions of dollars. Might sound a lot, but the annual need to solve the UN Sustainable Development Goals is $2.5 trillion a year, for every year. There's no way that government aid or government sort of developing country investment is going to get us anywhere near. So what can? It has to be private wealth. So then, because if you look at the volumes of private wealth, we're talking about $300 trillion. And then if you talk about the 0.1 of 1% of private wealth, it's about half that. So we're talking about somewhere between 100 and 200 trillion US dollars owned by the 0.1 of 1% wealthiest people. They only need to invest 1% of their total wealth every year, and we've pretty much got all the money we would ever need to solve the world's problems. So I then pivoted and said, okay, the ESG institutional pension fund space is going really well. I'm now going to pivot and spend the next 10 years focused on mobilizing private wealth into impact investing, which is that early stage venture, frontier markets in particular. So I then went to Harvard as a senior fellow at the Kennedy School and set up a new executive education program on impact investing for the inheritors of the world's wealthiest families. And so in 2015, in collaboration with the World Economic Forum's family business community, we had our first cohort of inheritors, about a third of whom were from billionaire families, but all of them were sort of ultra high net worth people. And we've now run this course 7 times. It's now moved to the University of Zurich, and we have spun out a centre called the Centre for Sustainable Finance and Private Wealth, which is the only university centre in the world that is focused specifically on mobilizing private wealth into impact investing. And this is now at the University of Zurich. And we are also partnered with MIT for the US module. After 7 years, the Harvard unit is sort of moving to MIT. And this has come along, so this move of mine in 2014 into impact investing and private wealth also coincided with the next big United Nations set of frameworks called the UN Sustainable Development Goals, which was launched in 2015. Now, the UN Sustainable Development Goals is not designed for investors. It's designed for countries. It has 17 country goals for solving the world's problems. So the principles for responsible investment that I led was specifically designed to mobilize capital into the ESG direction, focused on the financial materiality. But then by 2015, a lot of investors, you know, in the same way that I was realizing we needed more money to go directly into the more impactful end of the spectrum. So impact investing is that subset of the broader sustainable investing spectrum where you can really show that your money is actually creating a real positive impact. And that is either through private market impact investing, venture capital, microfinance, private debt, or shareholder activism actually can also be classified as impact investing if it is robust and can demonstrate that it can make a really big difference. So then after 3 years based at Harvard, I realized, well, I need to go and embed myself more deeply in this world of ultra high net worth people. I've been teaching them for 3 years. Now I need to go and work directly with them. And so that's when I went to UBS as head of impact investing, and then went across to Credit Suisse a few years ago as head of sustainable and impact advisory. And people often say, well, you know, after your years of working at the UN and working at, you know, teaching at Harvard and so on, you know, how did you end up working for a bank? I'm like, this is where the clients are. This is exactly where I should be if I am trying to execute on this strategy of mobilizing private wealth. The big wealth managers like UBS and Credit Suisse is exactly where people like me should be, and we really need to continue mobilizing this group of people. With that, thank you.